It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price.
Yeah.
Yes.
Everyone has a story about how they invested in a hotel deal, a multifamily deal, especially like right now, or even a Ponzi scheme, which is crazy.
If I had money and I wanted to stay rich or stay wealthy, I would deploy money in a multifamily, which covers manufactured housing.
Demand for affordable housing actually increases during a recession. So there's more demand for this product. And so when people are looking for certainty, this is a space in the market that they're gravitating to.
Welcome to another episode of the CashFlow Quest, everybody. Today it's a panel with myself, Jen Purcell, Blake Comfort, and Ben Schuster. And recently, Ben went to a conference called The Money Show in Las Vegas, Nevada. And I just wanted to let's talk about it. What'd you learn and who was there? What'd you guys talk about while you were at The Money Show?
Yeah, thanks, Jen. So Morgan who sits on our investor relations team, we went to Las Vegas. We were at the Paris for 3 days for this conference. It's been going on for about 40 years, probably brought in around 1,000 to 1,500 financial advisors, investors, other retail investors, attorneys, you name it.
Mm-hmm.
And they had a big hall where they'd have speakers, and then they had a breakout conference room where people had their booths and panels. So we had a Comfort Capital set up there. And I thought what was probably, most interesting is that, we get in, we fly in the morning of, and we're stumbling into the first, opening session.
Right.
And Mitch Rochelle, who's an investor, and he's a talking head on Fox Business and CNBC and others. They usually go to him for any housing market update. And as I'm sitting there, and we're in the back because we came in a little late, and he's doing a Q&A session, just wrapped up his remarks on the real estate market. And a gentleman presses him on what's the best real estate opportunity today. And I kid you not, he says, mobile home parks, and which is wild.
So cool.
Yeah, which is amazing, right? Teed us up perfectly for the entire week.
And I think weren't we the only booth there that actually was representing mobile home parks?
Yes.
So that's even better. I couldn't have been teed up any better.
I didn't have to pay him even.
Yeah.
So it was perfect. But yeah, and so I think he went into why he believed that. And then I had a solo speaking session where I talked about is it educational about the investment opportunity in manufactured housing communities or mobile home parks, which I talked about their resiliency. And I had a lot of folks that, all weekend went to all of my different sessions and were asking me a lot of questions, and were just really interested in what we do. And it was kind of cool. It was eye-opening because you have, all these famous traders, the AI guys, the oil and gas guys, the gold guys, that are there as well. But when it comes to real estate, we definitely stood out. And I think, investors are just looking for something that's differentiated, that can provide some certainty during this uncertain times with,
right.
And a lot of these folks, they're investors, right? So they invest in multi, or they've invested in a hotel deal. And so you hear those stories about, hey, yeah, we're getting capital calls, or hasn't been performing very well. And so we were kind of that shining star in the sense of people looking to diversify and find resiliency in their portals.
Yeah.
So who was there? I have no idea. What's the demographic, or what type of person goes to the Money Show? Yeah.
So this is our first time going. The demographic was mostly call it 50 and above, right? Okay. So it's folks that are looking for ideas and want introductions to really kind of interesting investment opportunities. So whether it's options trading in the stock market, or it's investing in precious metals, or how to invest in oil and gas, you have all these thought leaders that are there that are provoking ideas. And so a majority of the people that pay to go there are investors. They're looking, mostly retail investors, right? Kind of our crew, as well as the demographics match kind of our investor base. If I were to kind of put a pin on it, right? These are folks that are either, they're business owners. There was, I was talking to a handful of doctors. They're folks that have cash, discretionary cash, and they're just looking for ideas on how they can deploy that.
Grow their wealth.
Exactly. Grow their wealth.
Do they have to be accredited to go?
They do not. I don't believe, but most all of them, at least everyone I was talking to, they were accredited, and you can kind of gauge that pretty quick in a conversation. There's definitely some people that are kind of going around and just grabbing the free pens and stuff. Right?
You're always going to have those people at every conference. Yeah.
Yep. Our pens sell at a premium.
Yeah, our pens are hot. So
okay. So then my questions relating to the money show are really like, what were the hot topics? So let's go through everything but MH, just because we were teed up so nicely.
Yeah.
And I looked up Mitch. He seems like a legit talking head for I'd say, all things real estate, rental real estate. I watched some of his videos and it's cool. So it's neat to see that he said manufactured housing.
Yes.
But we'll come back to that as kind of what we're sensing in the market too and where that's going. But the other pieces that you mentioned were a hot talking point amongst the show was AI, crypto, and oil and gas.
Yeah. Yeah. So those three, if I were to take away themes outside of what we do, those were the big talking points. In AI, they had Dan Ives speaking, and Dan Ives works for Wedbush. He's kind of famous in the AI space. He is a equity research analyst for Wedbush, which is a large investment bank platform. And so his talk I was really interested in, and he talked about AI being the fourth industrial revolution, and that we're still in early stages of this growth. So you kind of had this like competing battle, which is kind of interesting. You had the value guys. You could think of like Warren Buffett, right? The bears essentially saying, hey, the stock market is completely overheated. Yeah. And if you look at like price to earnings ratios, they're at all time highs. And then you had this other competing interest, the bulls, right? They're like, no, this is going to keep going. And so, which I thought was really interesting. And then some of the things that he talked about was, you had like the first derivative players. So like Palantir, which it has gone up like 10x in a year. Obviously NVIDIA, who's creating the chips that power the AI. And you've seen that go on an absolute tear. I think their market cap now is like $3 trillion, which is just insanity. But what's their PE ratio, or do you have any idea? Oh, no idea. Yeah, no idea. Honestly, I've looked it up before. It's probably like you spend $300 for $1 of earnings. I would assume. Yeah, but look it up.
I'd probably quick Google search.
I'm just curious.
Yeah, I'd be curious.
While you're talking, I'll just
pull it up. And then he talked about, which I thought was most interesting on like his talk, was that you're now going to have these like second derivative companies. So like Apple. Right. He touched on Apple, Oracle, Salesforce, all these other like big software. Yeah. But as it relates to Apple, the iOS platform, a lot of the AI, apps and so forth are going to be built upon that Apple, AI platform. And so he was still really bullish on like Apple. And then Tesla, he talked about that Tesla he really likes, and it's not because of the current business, like electric cars. It's really the robotics, and that's going to be a huge kind of growth going forward, is just robotics and autonomous technology and so forth. So that was really interesting. And I think like, if you're a stock player, like looking at, those are the things that kind of gets you excited to like hear someone talk about that. And he was just like in China, like he goes out, he's like actually in the market. So he knows these companies inside and out and really understands it.
Oh, wow.
So that was interesting. The other topics that were
real quick before we move on, NVIDIA's price to earning ratio is 50.
Okay.
So that's for the stock price is around 127, 128.
Yep.
And earnings per share is $2.50. So it's 50.
Okay.
Just to put that in real estate context, like a 5 cap is a 20.
Yep.
Price, price to earnings ratio. So that's like a 2 cap.
Yeah.
Yep.
And that's pretty wild.
Yeah. And I think
that's a lot of future projection going into that.
Yeah.
Exactly. Look up like the S&P 500 price to earnings ratio. I think it's like around 20 right now. That's why I was thinking when I said 300 for NVIDIA, I just thought it was going to be just insane. But 300, I mean, it's a 2 cap. I mean, I want to buy a 2 cap deal.
Yeah.
50. Well, yeah, it's like an exponential factor.
Yes.
So like going from 25, let's say, which is like probably Apple and like all these old like blue chip bond level stocks that you could trust. Those were like historically like 30. Mm-hmm. I don't know what they are right this second. But like I'll do a little more digging, like top price to earnings ratio. But like 50, that's like that just you think there's going to be so much value creation in the next 5 to 10 years.
You got to really increase
that you're
value.
kind of riding this speculative wave. Like I think beyond like 30, you really get into speculation heavy.
There's a lot of uncertainty there.
You know, it was also interesting, and for folks where like they're like, how are you tying a cap rate to a price to earnings ratio? And if you think about just how a stock price is derived, it's future earnings. It's all future expectation.
Right.
And so that they generally do, price over earnings. And that's a ratio where a cap rate is the inverse of that. It's just, net operating income at whatever time you're pulling it. Usually like when usually when you're buying a deal is generally like an in-place cap rate over the purchase price. And so that's why you have that inverse. So you could actually like flip it and look at it exactly how you said, like a 50 is like a 2 cap, right? But one of it was actually Mitch in his breakout session. He talked about, he pulled essentially the inverse on, I think it was residential real estate, cap rate performance versus like, the overall price to earnings ratio over the S&P 500 and showed the outperformance of real estate over the S&P 500 over, I think it was a graph. I could put it.
Years.
Yeah. Well, it was a long time. I think he pulled it for like 50 years or maybe it was the last 25 years since 2000. But it was
like the historical average is like 9 or 10% for the S&P.
Yeah,
with a couple of good 2-3 years right now behind us.
Right, yeah, so he's essentially showing that the earnings for real estate outpace per price that of the U.S. stock market, which I thought was super interesting when he pulled that. And I don't know if a lot of followers could like really understand what he was doing, but I was like, that is a great graph. I want to.
That is a great graph. And it proves that like the volatility of the stock market it's either high or hot or not. Yeah. And where like you have real estate, that's just kind of the ballast, as you say, in people's portfolio is kind of the slow and steady. But if you can know how to work the market and get in and out and the highs and the lows, then it's a good place to invest too. But you got to kind of know it and play it a little different. And so that's what's so interesting with your list, going back to that of like AI.
So the S&P
and oil.
500 is at 29.9. Okay. So 30, the whole thing.
Yeah.
Which is 30, which is really high.
God, that is.
For a blend.
Yes.
An average holdings.
500 of the largest companies in the US.
And that's where it's just such an interesting moment in time right now.
I know.
Because like there's a little bit of like bad news across the global macro, the money printing, the control of cost and the government spending. And it's like, where is this all going? And so I'd say the three of us are more hedge oriented, you know, but there's a place for these big gains. So we have clients and investors that are like, well, I made 50% on my money.
In like 2 years.
Talk to me when the market's not ripping. And it's like, they will.
Yeah.
They will. It's just a matter of time.
Yeah. And that's why, like, when I talk to investors, whether it was at this conference or to our investors, I'm never opposed of being in the stock market, right? But I think that you need to understand when you're in the stock market is that when you're thinking about like the overheating, like you're seeing now, and who knows, it might continue to go higher. Like I'm not saying it won't, but there's a lot of room for error. Like bad news could really send the market. I think it's pretty fragile right now if I were to just sum it up. And you need to have the ballast of your portfolio, right? Like you need to have your hedge, your security, your cash flowing, whether they're, strong value dividend paying stocks or the way that we look at it, it's strong cash flowing real estate. That way you can go and take, excess risk with, a portion of your portfolio, like 20%, and you sleep great at night because you don't really care.
Yeah, you're just having fun over there with that 20% to see what AI is going to do or oil and gas or whatever the hot stock is in the market at that time. You can have some fun.
Like I couldn't stomach if I had 100% of my, my portfolio in the stock market and then it drops 20% or 30% during the next, recession, like that would hurt, that would, and you see that red on screen and you see like, minus X amount on your brokerage account. Like
that's like those people who can't stop looking at your phone. You're like, oh God, wait, what do I do? It's like you're glued to it.
Yeah, that's one piece I think is really a tricky dynamic to set it and forget it.
Yep.
And that's, I think, why Buffett made such poise in particular, like very thoughtful trades
and was patient
on scale.
Yeah.
Because when he bought in, and then he moved on.
And I think that's a great segue to just kind of what my talk was. So the topic of my discussion was manufactured housing communities, resilient investments for a changing market. And in my opening remarks, I had a picture of Warren Buffett. And I said, everyone knows Warren Buffett, right? I was like, what does Warren Buffett know that you guys don't? At least not yet. And one of the interesting things about Warren Buffett is he's the largest investor in manufactured housing communities. He's not a real estate investor because Berkshire Hathaway wouldn't make sense to actually hold the real estate because you're not going to get the same tax benefits. And he talks about that, but he owns actually the operating companies that support manufactured housing communities, such as Clayton Homes, which is the owner of the largest builder of mobile homes through a subsidiary Berkshire. He owns 21st Mortgage, which is the largest financier of mobile homes.
Manufactured home sales.
Through Berkshire. And then he owns Berkadia, who we just had Art on last week as a managing director there, who's the second largest lender, I believe, on mobile home parks. Yeah. And so Warren Buffett loves this space. And then Sam Zell, which I talked about as well, legendary investor. I mean, if you're in real estate, Sam Zell. And he's like quoted with saying that trailer parks are the best real estate investment that ever existed. Like, those are pretty lofty praises from two like legends.
Pretty cool.
And talking about this overheating of the stock market, and Buffett's been pretty good on predicting this stuff. And it doesn't happen overnight, but he's holding on to like $300 billion of cash right now, which is the most cash ever that he's held on to, like as a percent, right? Because inflation and so forth, and the stock has grown. So he's sitting back, and I think he just had his, his yearly annual letter that he released, and I didn't dive into it, but he's just like, basically there's no businesses that look attractive at these prices. And so he's kind of if I don't know a lot about most things, but if Warren Buffett's sitting on the sidelines a little bit, he definitely reads like 600 pages a day. He's been doing this forever. He's like 92 years old or something like that.
Isn't he a big component, or he likes to be patient, right?
Yeah.
Like he's not going to just buy a business because he's got $300 billion in the bank. Like he's going to be patient, even at the age he's at, still going to be patient to look for the next best deal and make a good, solid move. Like to your point, like he waits. And when he's in big time.
When I pulled up his famous quote that I was slaughtering the other day in a meeting, which is, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price.
Yeah.
Yes.
And so he just focused on good baseline businesses.
Yep.
And then they grew in demand from a stock price because of that resiliency and long-term brand awareness, or whatever the dynamic may be. But that's where he's looking around, and it's like, these things are all, price per earnings are just wild.
Mm-hmm.
Yeah.
And then he's now at the helm of huge dollar decisions, that like if he swings billions into certain companies, like it'll potentially hurt the company.
Yeah.
It's going to swing the needle in different ways.
Yeah.
So he's made comments. I've listened to videos, and he thinks that there's really great opportunities for smaller dollar, check sizes or smaller dollar amounts to play in the market right now. But for them, it doesn't make sense to swing tens of billions of dollars around. It's just a wild dynamic right now with the way the financial system is being managed to make those large trades.
Yep.
And I think like two things can be true at the same time, that we are in the fourth industrial revolution on AI, and there's going to be some big winners, and there already has been, and there will continue to be, like early .com, right? Or in, .com. But I also think that the market is overheated and we're due for a correction. So it's like so I think there'll be good opportunity for folks that are like stock pickers and maybe can buy the dip. But if you are playing that game, you just know that it's going to come with a lot of volatility. And most of our investors have already made a majority of their wealth that they're going to create in their lifetime. And so they're not looking flip a quick buck, and they're looking to preserve their capital and cash flow that capital, and then do it in a very tax efficient way. So, there's different strokes for different folks depending on where you're at in your life. If you have time on your side and you're a risk taker, I'd say, it's a great time to probably get in, do research on some of these companies and do so. And you could wear that volatility because you're not a forced seller, right? You have time on your side. But for for individuals that are retired or approaching retirement, they don't want to wear that volatility, nor should they.
So one of the, just going back into our roots, which is real estate focus, one of the good quotes that I've heard lately is somebody was asked, so what asset class is your pick? What's your winner and loser? And the guy's like, okay, if I was going to stay rich, if I had money and I wanted to stay rich or stay wealthy, I'd deploy money into multifamily, which covers manufactured housing as a broad stroke. And it's because we are still in a housing shortage over the long haul. We have a decent blip of inventory coming online right now. But after a couple years, plus some of the reorganization that's happening in multifamily assets across Class C, Class B, some Class A, that will get absorbed in the market, and the pricing for rentals and the overall average rents will kind of normalize.
Correct.
And then if inflation continues forward and things continue to get more expensive, then you're back into a solid investment that's more of a bond, long-term growth, 10 plus IRR, even Class A. And then he's like, okay, if I was wanting to get rich, I'd be studying the heck out of office.
That's interesting. I sat on a real estate panel with 3 other gentlemen. And one of them was, he was doing single family rentals, SFR on scale, sold it. I think Carlisle might've been his equity that backed him. So he did really well on that. And he said, I just couldn't make sense of it anymore. And so he got out like last year. And now he's just rebranded and he's going after distressed office. And he's like buying in the Midwest and so forth. He's like, it's great. I'm getting like 10-year leases in place in the Midwest where they're working. And I'm buying this stuff at like 10 and 12 caps. So, that's the opportunity of cycles. And
totally.
If you're sharp and, you're looking at those unique opportunities, they exist.
And you're not over levering, not using too much debt at too high rates. And it's like, okay, hey, I'll get a 40% loan on this office building at a 12 cap, and they're going to cash flow.
And they're at like absolute triple nets. So you don't have to pay for anything, including like property taxes or insurance or anything like that as well. And, because the tenant will pay for that. That was interesting.
Should we buy an office building?
Well, that's what I was just going to ask you guys. Like, what have you been hearing talking to different folks about office? Because obviously there's a lot of supply with what happened through COVID. A lot of people are working at home, but I've heard recently that that's showing not to be as productive anymore as time goes on. And so a lot of people are coming back to office space, but which would then bring the demand for office space, and people would be buying the inventory. If they're buying it now, they're getting obviously good price. But what have you guys heard on that?
Well, I think that remote work as a global big discussion, it's not good.
I agree.
Sure, there are good uses for it.
Yeah.
I think that policy could be reasonable. You know, let's say, hey, we're good with you working at home 1 day a week.
Mm-hmm. Yeah.
And it's kind of an understood thing, but you need to be here at least 4 days. Because you're going to be out of the loop, out of the vibe. We've had people that move away for just, family reasons or whatever, and they work with us. And we love them, but it feels different.
Well, the culture of the
you
office,
just lose connection, and the vibe of the team working together on a common goal is not the same.
The momentum of that is really
really difficult to build momentum.
Yeah,
and I agree. I have a bullpen, right? Like my office, I don't, it's where I'm surrounded with everyone because I will say something out loud and, Michael, our acquisitions director, is right there, and boom, the information is right there. Then I have my analyst who absorbs our conversations and is in the mix, and it's so fast, so efficient. It's I'll be off the call with a client and it's okay, hey, or even pause 1 second, ask a question, and it's there immediately. So that efficiency. And then I think too, from, a culture and like developing talent. Like I could never gotten to where I am today if I worked from home starting when I was 21 years old to, now into my 30s. There's just no way. You're just so disconnected. And so it could work for the executive or the person that's kind of like, hey, I don't need to be in the office because I kind of know what I need to do. And, it's like I can go run. For sure. But what about the people around that you're trying to build up and they need to hear those conversations
and learn from others in the office. You 100%. Can't do that when you're by yourself at home behind a computer.
No. And that's why Jamie Dimon, the CEO of JP Morgan just came out really hard and said, no, you're coming in 5 days a week or quit. And then I like to like read the comments or whatever, when it's like posted on X and stuff, and people are really strongly against it. But I think what happened and actually.
Yeah, but everyone's living in their damn sweatpants with an overgrown beard. It's like, come on. It's a mark of being soft as a country.
I agree.
Like, sure, there's some cool benefits to it.
There
but
is,
like the days I stay home because of a kiddo thing or something, you don't have the momentum. It's really difficult to have the momentum.
I agree. And I think too, just an interesting dynamic was that when you think about who had the power over this last cycle during COVID, you had a labor shortage. So that's why everyone was just getting paid more, right? Because it was hard to get talent. And there was this like competition for talent. So the employees had the power. I think it's going to start to shift to the employers having the power. And that's when you'll see people coming back to the office in a meaningful way of major cities.
Yeah, I can see that.
But I love being in the office. I like being a part of a team and being able to collaborate.
Get energy from that.
Yeah.
You just like,
And you just move. Yeah. It's fun for me. And if when I'm sitting at home, like, during the COVID, when I was working for BlackRock, it's fun for a couple of days because I'd go work out at like noon, know?
Right.
Nobody's there.
Yeah, exactly. But it gets like lonely. And also too, it's like, oh, I have a question or something. It's like harder to like pick up the phone or like an email or something when you just pop up and you're like, hey, like what
about that?
The connectivity and the ability to have the camaraderie is so important.
Yeah. So I think there's opportunity in office for sure.
So wait, if you're listening to this and you are looking to get into a space, so like Tide and I are looking at 5-10 years kind of thinking about it. He's like, you should be considering an office.
Yeah.
Like you should start dreaming about where the office ends up. And cause we're in our hangar building and it's awesome.
Yeah.
But like, unless we cut it all up into little cubicles, basically we're going to run out of space.
Yeah.
Yep.
And I still think we have some time, but like how much? We're going to build our studio over there. We're going to maybe cut up. We're thinking about maybe adding some like little desks along that studio wall.
I know.
Cause it's like at the end of the day, like we might as well use the upstairs.
Well, yeah, we should. And those are cool spots.
But okay. So then it's like an interesting opportunity right now. And I had a thought about like calling some office brokers or maybe talking to you about like who could we chat with just locally if there is an opportunity. We always kicked around some mentors of ours bought a building. They occupied a certain portion of it, rented the rest, and it ended up being a cool investment. Maybe you break even on your office cost so that the other tenants paying the mortgage or whatever.
Right.
And so like, do you think that's an opportunity for people, including us?
I think so. And I think it's like office had this like flight to quality and it still does. And so the BC office is really tough. That's a really tough market. And so unless you can, say we're not the owners, right? Unless the owner is willing to give you significant TI, tenant improvement budget to then open it up, because it's really like compartmentalized, the HVAC is old, it's like, it's not where you'd want to be.
It looks like the show, The Office.
Correct. It's not where we would want to have
yellow walls with like old blinds. Yeah. You need some improvements. It's not where we would want to
have our, day-to-days in, right? Well, it's like you want big windows, open space. You want it to be inviting. You want it to be nice when you bring, clients in.
We've got a vibe at the hangar right now too. So
then do we continue at the airport? Like what would be your guys' take on this? I'm just sharing it.
I love being at the airport, so I think we just buy a bigger hangar, but that's also like selfishly speaking.
No, but I'm with you. Like Patrick Bet David just bought a really cool hangar.
Yeah, so I heard that.
And that's his office and his studio. And then he hosted like his big media, like, presidential election whatever live in his hangar. And so I'm like, well, do we just keep leaning into the airport part? I mean, I love it, obviously.
It's a great community, you know. I think it would just have to make sense and compare it to like, you know, I would compare it to like what else can we find and what other areas.
Would you want to go to like a bougie office location though? Like that's it. Cause like, and then that's going to be more expensive. Like, are you willing to go to like downtown El Cajon in an office building?
No, thanks.
Or,
No.
Sorry, Bill. Or like La Mesa or like Poway or, I'm just bringing up some ideas.
Yeah.
Like,
I mean,
you want to go somewhere where you can have a vibe.
And I think too, one of the interesting components about being in the hangar is that we host these big investor events where we have 100, 200 people in the big hangar bay. And then we do, Jen does a great job with like, all the stand-up tables and all the decorations. And that's really cool.
And it is a vibe, right?
Yeah.
Like to bring clients in of ours and utilize the space. So to find kind of like a multi-purpose kind of space, because if we were going to go out and look for office space, that would be 100% that's something I would consider, because we are going to continue doing investor client events. And it's really nice to bring people to the office. They get to see where we are. They get this cool kind of space and camaraderie of the people and where we work every day. And it's just kind of like, it works and it's kind of a cool thing and it's different,
yes.
right? It stands out, which is, I think, something we all really like. And so if we were going to go shopping for office space, I think that would be something really strongly to consider. You want the draw.
You guys like our hangar parties.
It's a normal like building with no like view to something in an office space. Yep. It's kind of like, you don't really get excited.
Office space, right? It's like gotta be something like creative. And I think too, it's just also demographically, like the millennials probably enjoy something to be different. So if you are in a bougie or a nice spot, like in like Del Mar or whatever, you pick the one, it's going to have some component about it that excites you.
White collar surf rat, like hang your surfboard up and go into the office in Del Mar, that's cool.
Yeah.
It is cool.
Like, we've gone to, some of our friends have an office off the main drag, inland one street. But like, you go into the office and everyone's in their flip flops and a polo and they literally could walk to their office from the beach. Like that's cool.
And there's a bar downstairs and all that. So yeah.
So for East County, it's for us out here, it's like the airport's kind of the best of both worlds.
Yeah, because otherwise you're kind of in a fine office building, but it's not exciting. Where like if you go to the beach and have and that's kind of cool. Like maybe that would be an opportunity to have like a multi-purpose where you have like office space on the top and shops or restaurants or on the bottom. It gives
a mixed use.
It gives like that mixed use draw.
Yeah,
that would be cool. But then
Whistle, his downtown La Mesa spot is really cool.
Very cool.
And like you're in the mix.
There's a community around.
And he loves it. He lives in Poway and he's like, man, I love it here, but like the drive, I like being in the mix with all the people.
Yeah.
So if you're an office broker in San Diego, reach out.
Well, honestly, it sounds like I have a job to do, which is find another hangar.
Well, that was it. Or we find another hangar, and there's potentially some opportunities there where, like, if we could get one that's close, then you kind of like create this larger event area where you can like walk, and it expands that fun vibe even more.
Yeah, we can't really walk anywhere, so that's the only downside. But other than that,
so we have to put a beer kegerator in and the whole thing. We'll just build our own bar.
That's you.
I'm just having fun.
Yeah.
It's cool because like the Dunder Mifflin, what's the name of it? Dunder Mifflin. That is my version of hell.
The Office.
The Office.
Oh.
What is that?
Dunder Mifflin.
Yeah, I don't watch that
my
show.
version of hell. Yeah. And it's why I can't watch it. I cannot watch The Office. I think it's hilarious, but like I get claustrophobia just watching it. Like that is something like Pat's choose your enemies wisely.
Yeah.
An office building was my version of an enemy. I was hell-bent on ever making it into an office building. It felt like when I was in school, when I tried college for 2 weeks, it felt like the program that I didn't want to run.
I love that.
It's like,
and so it just brings me joy to hear you guys talk about not wanting to go to an office because it's the last thing I want to do. But I think it's noteworthy from an investment landscape standpoint. If you could find like a Class A location, Class A office building as an investment, probably not a bad idea.
And if you could rent it out and get some income from it, it's a good business plan.
And as we grow too, you have headcounts and then you have to make tougher decisions that are just, purely off of, this is kind of what you're getting to.
Space
right?
planning.
Yeah.
Exactly.
Which is a good problem to have, but you want to overdo it, but you don't want to underdo it.
Right.
Correct.
So yeah. Well, cool. That was fun. Little impromptu discussion over office, but it's also like the real conversation about like, if you're trying to grow a business, where do you go?
Yeah.
So it's an interesting landscape right now.
And I could bring us back to just as far as a little bit on the money show. So we covered office, that was covered there. And I do think that's an opportunity, but then why people were kind of flocking to our booth and to our sessions on the manufactured housing communities. I can just kind of talk like what I'm hearing from investors, right? Like what are some of the common questions that I hear? And then also like what attracts people to this space
and how are people accessing it?
That's challenging, right? Because we don't advertise. And so I just happen to be there. And so people are like, oh my gosh, I've been always interested in this space. And, so great to meet you. Like I had this doctor's like, thank you so much for being here. I'm like, no, thank you. And, which is like, interesting, but, but like, what am I hearing from investors and, inclusive of like the money show? And really like, if I think about like boiling down themes, it's like certainty. People are really looking for certainty right now because, if you talk to enough people that have been investing, over 10 years, 20 years, 30 years, you pick your number, everyone has a story about how they invested in a hotel deal, a multifamily deal, especially like right now, or even a Ponzi scheme, which is crazy. Like and that's the one thing, especially like the Ponzi scheme aspect is something that
lately,
I had
like just recently people ran off with money.
Well, I just, for one, I talked to a lot of investors. I mean, I'm shocked of how common that is. Right. And it's shocking. Right. And it's not always like a straight, Ponzi, but it's like, people that are not fiduciaries and losing investors' capital. So I think that like one of the things that attracts people to this space is not just because it's like unique and differentiated in the affordable housing component of it, but it's also too just the fact that if you look at a graph, and I had one up, and you look over the last 20 years, MHC's outperformed every other major real estate asset class in terms of performance and provides the most stable cash flows across every other sector over the last two recessions, even, right? Even net operating income increased during that time. And so I put up that graph and just like eyeballs pop out and it makes sense to me. But like, as I'm like reiterating to investors, it's because demand for affordable housing actually increases during a recession. So there's more demand for this product. And so when people are looking for certainty and they're looking for stable cash flows and stable returns, this is a space in the market that they're gravitating to. Yeah. And I think just overarching, if you like talk to people, it's like people are just looking for like, what do I do with my money? How do I protect my money? How do I grow my money? And then obviously like that's the asset class portion of it. But then it's also like the underwriting of people and finding really good, genuine people that you could trust, right? And that have been around for, like for us, 16 years, but that have been around and are going to stay around for a long time. And then, have a big bench of investors that are normal people that they can call and, hey, have you been investing with Comfort? How's it been? Do they mean what they say? And so I gave a couple, we have great investors that are like references that would always, 100%. And so I handed off a couple of those to some clients that are like, hey, I'm really interested in learning more about this. So I think that's like really like what it comes down to is people are looking for certainty. So even if you're like a capital raiser or someone listening to this, like, this podcast and you're like, hey, how are you able to raise this capital? I mean, it really just comes down to, it's a long-term, game, in terms of relationships. People just don't write $100,000 check after they met you once. I don't care how good your speech is or how good your pitch is or what your returns. It really comes down to
formulate a track record.
It's a track record. It's trust. And then it's also just doing what you're going to say. And then it's that certainty piece. That's what really gets people comfortable. People aren't, people don't care necessarily if you generate a 20% return or a 12% return. They do care. I don't want to say, but like that's not what's not going to have you get a reinvestment. What would absolutely make sure that someone runs away and tells 10 other people to run away and stay clear away is if you do something that's unethical, you lost capital.
Money, you do a capital call, you quit distributing cash.
Yeah, you're not good at communicating.
Here and there, it's one thing, but like, man, the guys with multifamily that took all that floating rate debt and didn't hedge, I mean, it wasn't smart.
No.
Across so much of their portfolio. And
if you're a large operator that's been around for 40 years and you took a couple of deals and had that, but you have staying power, you can get out of it, right? And yeah, maybe your investors get a little bit of a capital, like their cash flow is going down or whatever. But you have staying power. You have liquidity.
You got to have some balance sheet power. Yes. You got to have some liquidity to like if you had a couple deals, if you've been around for 40 years, you probably have some cash sitting to where you can step in as a sponsor and make sure it gets refied out to fixed rate.
Exactly. But if you're like, guns blazing and trying to grow super fast and take on this excess risk and you did that across your entire portfolio, then that tide comes out and you're stuck there with your pants down, you're toast. You're toast. And so that's the issue. And so I feel for people, like that's why we take our roles so like personal, because it's like there's so many crappy investments out there. And I just know how hard it is for people to make a buck. Yeah. And it's like, I just want you to keep your money and grow it, and like, it doesn't have to be with us, but it's like, if anytime I can give some advice or, hey, I'm happy to look at this investment that you're doing. I'm not a financial advisor, but I'll just skim it.
Yeah.
And
I'll
look
just
at the
give you my
docs.
2 cents on it.
Yeah. Because it's like, I don't care if I know you or I don't know you. I just don't want you to lose money because,
and you just, understanding the deal structure or the terms or the debt, to help somebody who might not know it as closely as we do.
Yeah.
It's just helpful. And there's so many pieces to this game, like somebody who is going to make an investment. There's a lot of variables that all three of us would look at and be kind of have an awareness around. And so sometimes that's hard for somebody entering the space. And it's just unfortunate that some people just get kind of taken advantage of or have people that have the manager controls that are making kind of risky decisions on
they make
stuff.
Honest mistakes, but it's
There's a component too. Last thing is like selling snake oil. Like you could have, I was talking to Morgan about this and you see some booths and some guys around there, guys and gals. And you're like, on the surface, it sounds like a great idea, right? But the ability to execute that idea and how many things can go wrong and how much time is going to be involved that you're probably not factoring in. It's like, to me, it's like, I wouldn't even touch it. It kind of goes back to like the Warren Buffett analogy that you made, right? Yeah. Like that's kind of a component of it.
Yeah.
It's like you could have the best idea in the world, right? But if it's how attainable is that going to be to actually execute on that? And like, what are all the risks and the things that you're not factoring in that are going to pop up and how much time that's going to take?
100%.
Yeah, those are the types of.
And I mean, we've learned the hard way that we've invested in some venture capital things that may or may not ever see the money back and may never produce any real gain to speak of.
Yeah.
And it's really like the opportunities were there, but the execution is where the rubber meets the road.
Yes, 100%.
And it's always harder than you ever anticipated. And the market's always going to change and go wider than you ever thought on everything.
Yeah.
And it's like, So, well, we do have a deal. Check out comfortcapital.com if you're ever interested in just looking and learning more. We'll get an email and then we can start to send you things. And we look at the management of our mobile home parks as stewardship versus like ownership. And we think we got it all. We are Christian, we are believers, and we know that eventually we are not going to have the physical control anymore as we leave this earth.
Yep.
So we are stewards of this business. And so we are honored by everyone that's a current investor and anyone that is looking at our deals. And we look forward to serving real people with, real long-term financial goals and building real wealth the hard way, which is slow and over time in great assets. And so that's what we do.
Love it.
Until next time, guys. Thanks
Cheers,
for
guys.
listening.
See ya.